Most 1031 exchanges don't fail because of the property. They fail because someone missed one rule. In this video, I will be going over the key 1031 exchange rules and requirements, step by step, so you can actually pull one off the right way. A 1031 exchange is a tax deferral strategy under Section 1031. It is not a tax loophole. It lets you delay paying capital gains taxes and depreciation recapture when you sell an investment property, as long as you follow the rules. The big idea is simple. You sell one investment property and buy another qualifying investment property, but the process is very rule-driven, and the IRS cares about timelines, paperwork, and how the money is handled. Think of it like a checklist. Miss one box and the exchange can fall apart. A forward exchange, also known as a delayed exchange, is one of the most common types of exchanges. This is the classic version. You sell the relinquished property first, then you buy the replacement property later. It fits normal real estate timing because most people need to sell before they can buy. The key is that you don't get to hold the sale proceeds yourself. Those funds must stay inside the exchange process. This is the version most investors use, and it's the one most people mean when they say, "I'm doing a 1031. A reverse 1031 exchange is when you buy the replacement property first, and then you sell your relinquished property later. This is useful when you find the perfect replacement property and you don't want to lose it. The challenge is you can't just buy it normally and figure out the exchange later. A reverse exchange typically requires an exchange accommodation title holder, which is basically a special setup to hold title during the exchange process. It can be powerful, but it's usually more complex and more expensive than the forward exchange. This is where having pros involved early really matters. An improvement or construction exchange lets you use exchange funds to make improvements to the replacement property. This can work if you want to buy a property and renovate it as part of the exchange. The big rule is the improvements must be completed within the exchange window, and the total value has to be in place by the deadline. In most cases, you're still racing the same 180-day clock, which makes planning critical. The option is great in theory, but the timeline pressure is real. The like-kind rules are about the use of the property and not about the style of the property. Both the relinquished and replacement properties must be held for investment or used in a trade or business. In simple terms, real estate for real estate, as long as it's not personal use. That means you can often go from residential rental to commercial to vacant land, or even trade one property for multiple properties. What matters most is how you hold and use the property, not whether it's a house, a condo, or a retail building. And a quick note, if you need help executing your 1031 exchange, my contact information is below. The 45-day identification period is the first deadline that trips people up. The 45-day clock starts the day after you close on the sale of your relinquished property. By that deadline, you must identify your replacement property choices in writing and deliver that identification to us as your qualified intermediary. And it's not enough to have a few ideas. Your identification has to be clear and specific. This is where people get hurt because the calendar moves fast, especially if you're trying to shop carefully. The identification rules decide on how many replacement properties you are allowed to list. The most common rule is the 3-property rule, where you can identify up to 3 properties no matter what they cost. If you want to identify 4 or more, you can use the 200% rule, but the total value of what you identify can't exceed 200% of what you sold. If you go beyond that, you're in the 95% rule, which is strict because it generally requires you to buy at least 95% of the value of everything you identified. In real life, most investors keep it simple and stay within the 3-property rule when possible. The 180-day exchange period is the final deadline, and it's an absolute deadline. You must close on your replacement property or properties by day 180. There's no almost, and in most cases, there aren't extensions just because the deal got delayed. The deadline is why your 45-day identification choices need to be realistic and finance ready. If your lender inspections or negotiations drag out too long, the exchange can get squeezed. The safest approach is to treat 180 days like it's shorter than it sounds. A qualified intermediary like myself is required, and we must be hired prior to the closing of the sale. A qualified intermediary, or QI, is the neutral party that holds the proceeds and coordinates the exchange paperwork. The investor can't have receipt or even constructive receipt of the funds, meaning you can't touch the money or control it like it's in your pocket. If the funds hit your account, even for a moment, it can blow your exchange. The QI is one of the most important pieces of the process, so don't treat it like it's an afterthought. Reinvestment rules and boot rules decide whether you get a full deferral or a partial tax bill. To fully defer taxes, you generally need to buy a replacement property of equal or greater value and reinvest all net proceeds. If you don't, you may create boot, which is taxable. Cash boot is when you keep some cash instead of reinvesting it. Mortgage boot is when you replace less debt than you paid off, and the difference can be treated as taxable value. Boot doesn't always kill the exchange, but it can create a surprise tax hit if you didn't plan for it. Title, taxpayer, and vesting rules can quietly ruin an exchange if you ignore them. The same taxpayer who sells must be the same taxpayer who buys. That means your name, entity, and vesting matter more than people think. Changing ownership structure midstream can create a problem, especially if you're trying to move property in or out of an LLC or partnership. This is why you want your CPA involved early, before you list the property, not after you've already under contract. A small paperwork mistake here can turn into a big tax surprise. The most common exchange killers are boring. and totally avoidable. Missing deadlines is number one because the IRS timeline doesn't care about your closing delays. Improper identification is another big one, especially when people identify properties incorrectly or too late. Receipt or constructive receipt of funds is a deal breaker mistake that happens when the exchange is set up too late. Misunderstanding boot can lead to unexpected taxes even when the exchange worked. The biggest pattern I see is waiting too long to bring in professionals. Your CPA, an attorney, and a qualified intermediary should be part of the plan from the beginning. A 1031 exchange can defer capital gains and depreciation recapture, but it only works if you follow the rules exactly. The biggest focus areas are like-kind use, the 45-day identification deadline, and the 180-day closing deadline. A qualified intermediary must be in place before you sell, and you can't touch the funds. And even if the exchange doesn't fully defer taxes, boot rules explain why you might still owe something. And that wraps up this video. Again, if you need assistance with your 1031 exchange, my contact information is in the details below.